It's Monday, October 4th. I'm your host, Jason Moser. And on this week's financial show, Google is abandoning plans to offer bank accounts. It's becoming prohibitively more difficult to own a home these days. And earnings season is just around the corner. We've got one company that my guest here has got his eyes on. And yes, it's my guest. He's my guest every week. I'm always happy to connect with him and bring him on the show here. It's certified financial planner, Matt Frankel. Matt, how's everything going?
Good. Am I really a guest anymore? I feel like I'm kind of like instead of a house guest, I'm like a cousin that has a key to the house.
Yeah, well, I guess I'm trying to be technical because really, honestly, at this point, I would refer to you more as a brother. But technically, I guess I'm the host, you're the guest. But yeah, this is way more of a collective effort on our part. So yeah, maybe let's come up with a better word for that next week. Let's come up with a better word. Matt, we were talking about this towards the end of last week, and this is just an interesting headline that caught our attention here because of the ramifications. But then also you kind of wonder about this just bigger picture perspective on big tech and how invasive they really could potentially be. Google is abandoning its plans to offer bank accounts to users. Now they've been looking for years now to sort of get their foot through that door, so to speak, in financial services, fintech, whatnot. And their goal, they were going to partner up with banks and figure out a way to offer banking accounts to users. Now that plan has been abandoned. What's the headline here for you in regard to this move?
Well, I mean, the big headline is that banks aren't as disruptible as we might have thought.
Yeah.
So Google announced this in 2020. They announced they were going to create a checking/savings account, like all in one product called the Google Plex account.
Yeah.
And they were going to partner with Citigroup and Stanford Federal Credit Union. That was pretty concrete plans. They had a name for it already picked out. And they just announced that they're going to abandon those plans to focus on, quote, digital enablement for banks. So they're going to, instead of being a competitor to banks, they want to be a partner to banks. And there's some big reasons for this. Google doesn't, and other big tech companies for that matter, don't really need to be making enemies with the big banks. Yeah. These are companies they rely on for revenue. A lot of these banks are cloud service customers in Google's case and in Amazon's case. You remember back
advertisers as well.
Right. They're advertisers as well. Remember back in 2018, I'm pretty sure we talked about this on the show. Amazon announced plans to do something similar.
Yep.
We never heard another word about it.
Yeah.
And there's two real reasons here. It's that they don't want to be competitors to banks. They want more of a mutually beneficial relationship. If Google partners with Citigroup and Wells Fargo is one of their big cloud customers, I don't know if that's true, but just say, that alienates one of their big customers.
Yeah.
The same could be said in Amazon cases. I guarantee you Amazon Web Services has a lot of banks as customers.
Oh, most certainly.
So that's reason number one. And number two is the one we always talk about with everything regarding banking is regulation. This wouldn't exactly involve Google becoming a bank itself. It would be, using Citigroup's infrastructure to offer the product. But at the end of the day, you're still offering financial products and services to customers. And that could make regulators take a little bit of a closer look. I don't know. Which reason do you think is the big one behind this?
I've thought about this from a number of different angles, and there are a lot of questions that came up because, on the one hand, it does feel like there are other examples of big tech companies trying to get some sort of entryway into a meaningful market opportunity. Payments is clearly a massive market opportunity. This makes me think of Facebook's efforts to try to get into payments. And they're still fiddling around with their digital or virtual currency, whatever you want to call it. I don't even know that that's really a thing still. So it makes you wonder, number one, is there a point where consumers say, you know what, I don't really want that, right? It's one thing to come up with something that a consumer doesn't even know they want yet, right? That was kind of Steve Jobs's MO. He was always coming up with design and form factors and things that, this is what the consumer wants. They just don't know it yet. And to a large extent, that worked out pretty well. But when you look at a lot of these big tech companies, I think there's a line that people start to feel like they are willing to draw, saying, listen, I like Google for X, Y, and Z, but I don't want it doing A, B, and C. I'm not interested. So maybe this is, hey, guys, maybe you need to kind of stay in your lane. I don't know.
Yeah, and I have to wonder how much upside there would be, even, let's say this product had worked out.
Yeah.
I mean, you really have two kinds of financial accounts. You have people who use traditional banks, like me, and I think you two you've mentioned on the show.
Sure. Yeah. Yep.
And then you have people who use things like Cash App and PayPal and Venmo primarily for their money transfer needs. So where does the Google checking savings account really, like, how many people would it take away? I feel like everyone's relatively happy with one option or the other out of those, either traditional banks or the new fintechs.
Yeah.
That is there really that much demand for a new banking product from these big tech companies?
Well, in even looking away from finance, and I mean, we've seen over the past few years efforts from big tech, Amazon, namely, trying to figure out their ways to get their foot in the door of the healthcare market, right? And you've got Amazon owning PillPack, I think it is, right? So that there's a little bit of an opportunity for them to exploit their logistics expertise. But is that something where, I mean, it like banks, I think you look at the current state of the healthcare industry. I mean, it's just a very difficult industry to disrupt. It's one thing to say you want to go in there and make it better. I mean, it's another thing entirely to actually do that. And so it does feel like even success there is going to be incremental, maybe at best.
Yeah, I mean, like I said, this is bullish for banks because it's showing what a hard industry that's going to be to disrupt.
Yeah.
Even all the new fintech players are getting bank charters now. When you think SoFi, Square,
yeah,
I wouldn't be surprised to see PayPal do something like that. But all the new fintech providers are getting banking licenses. It's really tough to disrupt banking without being a bank. So
that's very well put.
I mean, Square's done a good job, but even they're seeing, like, there's an upper limit. Same with SoFi. There's an upper limit to the financial ecosystem they can build out because, yeah, their lending platform is great. Their investment platform is great. Their money accounts are nice. But at the end of the day, I still need my Wells Fargo account to be able to go to the bank and to be able to write checks and things like that. So by having an actual physical branch network, which is what SoFi is going to ultimately end up doing, they acquired a branch-based bank not that long ago, or announced plans to do so. So it's really tough to kind of offer a banking alternative without being a bank. And like in Google's case, to do it, they would have had to piggyback off Citigroup, which would have made enemies out of everyone else in the banking sector, which they don't want.
Yeah, that's a good point. Final question before we go to the next story. Do you feel like, given it's not that Google's saying they don't want to be a part of this, but they seem to be focused on maybe coming at it from a different direction now, and like you said, enabling financial services, enabling the banks to do more. Now that admittedly is a little bit more behind the scenes, but even still, it feels like to me, given where things stand today, the quick development we've seen in the fintech space, some of the consolidation that we're seeing, it feels like to me, this perhaps results in Google or Alphabet making some acquisitions in order to build up this presence. Do you feel like that's a possibility?
Yeah, I wouldn't be surprised to see Alphabet or some of these other big tech companies like Amazon ultimately acquire some fintech providers to really. One thing Google mentioned in particular was virtual cards and improving the security of online payments.
Yeah.
So I could see them acquiring a fintech that maybe is developing some sort of technology to that end. But I mean, that's a big problem. Online payment security is a big problem, and all banks need that. All banks would benefit from that kind of service.
Yeah, and that sounds a lot like a company out there. I think we've talked about before on the show, Marqeta, which is in the card issuing and the virtual cards and the APIs for its customers to be able to sort of tackle that issue. So it'd be interesting to see. I mean, to me, you look at something like Marqeta, it's small enough still. Granted, it's brand new to the public market. It's still small enough today to where it's not out of the realm of possibility. That could be a big sort of elephant gun acquisition type move for something like Google if they decided they wanted to pursue that opportunity.
Yeah, I mean, it's a way to use their reach to benefit from from banking innovation without actually trying to be a bank themselves. And I think at the end of the day, that's really where all these big tech companies are going. Even Apple, you see, Apple's partnering with Goldman Sachs on a credit card, but that's because Apple is a consumer products company.
Yeah.
That's not because Apple wants to be a bank. They have some financial services, just like Google does. Google still has Google Pay, things like that. But Apple's has, to my knowledge, has never said they want to actually offer bank accounts.
Yeah.
And I could see it staying that way. I don't really see that being the way that all these tech companies are going.
Well, Matt, mortgage payments these days are getting a little bit more difficult to afford for a lot of people. According to the Federal Reserve Bank of Atlanta, the median American household would need 32.1% of its income to cover mortgage payments on a median priced home. Now, that's the most since November of 2008, when that number was 34.2% of income. Clearly, there is a confluence of events going on right now pushing house prices up. And it feels like we are getting to a point. We're seeing some signs. You're seeing a lot of folks that are being priced out of the housing market again. We've seen how that shakes out historically, but what do you make of this data?
Well, one, it's not just that mortgages are getting less affordable; it's that they're getting less affordable very quickly.
Yeah.
When you think, like, let's start at the beginning of 2020, right before the pandemic hit. When the pandemic hit, mortgage rates plunged from about 4% to under 3%. And home prices stayed relatively flat at that for the first 6-7 months of the pandemic. So that made home prices more affordable. And not to mention, all existing homeowners were refinancing, getting their mortgage payments down. I know my mortgage payment fell in 2020. I'm sure yours did too. I think you refinanced.
Oh, yeah, we refinanced. Absolutely.
So what you're seeing now is kind of a perfect storm of factors that are not letting homes become affordable. 23% year over year price gains in the median home in America. 23%.
I mean, that's not even close to normal.
No, normal's about 3%. Home prices generally keep up with inflation, which is about 3% a year.
Yeah.
So the problem is there are some factors that are helping homes become more affordable. Wages are up 3% year over year, for example. So that makes affordability a little bit better. Interest rates are still way below where they were at the beginning of 2020. But just to put that in perspective, the difference in a 30-year fixed rate mortgage payment between a 4% mortgage rate and a 3% mortgage rate is about 12%. So when you have home prices rising by 23% year over year and the cost of an X amount mortgage falling by only 12%, you can see how that doesn't really work in the buyer's favor.
Doesn't line up.
So homes are definitely becoming less affordable, and it's due to higher home prices, but that's caused by things like low inventory, a labor shortage that's affecting home builders, supply chain shortages that are affecting home builders. Yeah. Home builders all have big backlogs. Some even stopped taking new orders. So it's a big inventory gap right now that's driving home prices higher. Who knows how long it's going to last? Home prices are generally more stable than the stock market. Anything that can rise 23% in a year can fall.
Oh, yeah.
So I'm curious to see how this plays out.
Yeah, and it feels too like there is a psychology at play here. I mean, whether it's stocks or real estate or precious metals, whatever it may be, there is that fear of missing out, right? That FOMO, and it starts to drive that human psychology a little bit. To where people behave somewhat irrationally, right? They do things they don't necessarily need to do. And maybe someone is feeling like, oh my God, this is the last chance we're going to have to buy a house. We better do it now, even if we have to pay up for it, without even thinking really forward that, I mean, historically speaking, these things do correct themselves. And this is a bit of an outlier event. So, I mean, it seems reasonable at least to assume that at some point or another, housing prices should normalize. It's a lot more difficult, I think, to convince people of that, though, right? I mean, that human psychology is very powerful when it comes to, especially something like a home, right? Where so many people have that goal of becoming a homeowner. That's like the top of the mountain for a lot of folks. And now all of a sudden you're saying that may not ever quite be within reach. So you better just stretch yourself as much as possible now or else.
Well, the other side is we don't know if home prices are going to normalize or come back down a little bit. If inflation right now everyone's kind of basing all of their economic assumptions on the premise that inflation is going to be temporary. If that turns out not to be the case, and inflation stays at like 5 to 7% for the next several years, home prices might not come down.
Yeah, or it'll take a little bit longer for them too.
Right.
Yeah.
I mean, if $100,000 today is worth $70,000 in a few years, home prices are not going to come down like especially not to the previous level. I mean, they say inflation's transitory, but that doesn't mean things are going to go backwards. Yeah. Transitory just means it's a temporary bump, and then it's going to level off a little bit. But you're still going to have that new kind of price floor.
Yeah. When you start raising people's wages, you can't pull that back. When companies start raising prices on things like burritos and toys, they can pull that back at will when they want to juice sales by discounts and offers and things like that, campaigns and whatnot. But typically, again, those are they don't want to take that back. And so certainly you see, I mean, those prices, yeah, they start to go up, and we're seeing a lot of the economic conditions that are really prompting that. Matt, we are just not even a couple of weeks. I mean, I guess really a couple of weeks away from earnings season starting up. And I know it feels like we just wrapped up earnings season, but our lives are really just one perpetual earnings season, and that's okay because we love it. But earnings season is just around the corner. JP Morgan unofficially kicks things off for us on Wednesday, October 13th. What is a company, we'll talk about this next couple of weeks here. I wanted to highlight a company today, though, a company that you're paying particular attention to this quarter as earnings reports start to come out.
Well, there's a few. You just mentioned JP Morgan. They generally set the tone for earnings season, so I will be paying close attention to them. Yeah. Wells Fargo is, my stock to watch in 2020. So of course I'm going to be paying that attention to them. One that I find really kind of a fascinating case is SoFi, ticker symbol SOFI. This is one that went public by SPAC earlier this year. And the reason I'm really excited about this one, it's not just because their recent earnings numbers have been impressive. Their recent growth numbers have been accelerating, which is really rare for a company that's growing that fast. So just let me name a couple statistics. SoFi grew its member count at 113% year over year in the second quarter, more than doubling. Not only was that an impressive growth rate, that's the 8th consecutive quarter that growth rate has increased. In the first quarter, it was 110%. In the fourth quarter of 2020, it was 90%, the year over year growth rate. The third quarter, it was 74%, and on and on. So if that number keeps accelerating, things could get really interesting for SoFi. And the part of their business, there are two main products that SoFi offers. There's lending products, which is how it got its start. They're an alternative lender. And then financial services product, which is a new and by far the more exciting part of the business. This is their investment platform, their money accounts, their credit cards, things like that. That part of the business is growing exponentially. I wish I could share with podcast listeners this chart, but SoFi's, if I were teaching exponential growth in a math class, this is the chart I would use to show a real world example of it.
That's great.
It was up to financial services products. The count of financial services products that customers use was up 243% in the second quarter.
Wow.
243%. And this is not a small business. This isn't like it went from 1 to 4. Like their product count is in the millions. So if that growth stays anywhere near that level, it's going to be a really, really interesting quarter and an interesting couple of years, because financial services products, we've talked about this in our bank accounts with, I believe, Wells Fargo for both of us. It's really, customers don't like to switch those.
Oh, yeah.
So once SoFi lands a customer, that's usually years of recurring revenue and a long-term relationship between them. So 243% growth in customers that could stick around for years and years is pretty impressive. They were profitable on an adjusted EBITDA basis. They're still kind of losing money. They've been raising capital hand over fist in a good way at a very cheap cost of capital. They're doing this tech trend where they raised $1.1 billion recently in convertible notes that pay 0% interest. and they let the bearers convert to common stock at about 40% over the current stock price.
Wow.
So before there would be any dilution, stockholders would have to win by 40%. That's an incredible cost of capital.
It is, but also, I mean, that's certainly a sign. I mean, you don't read too much into it, I guess, but it's certainly a sign that there's a lot of faith out there that what SoFi is doing is working.
Yeah. Oh, for sure.
Yeah.
Oh, there are people who think this is going to be the next 10 bagger in the financial sector.
No.
I mean, I don't know if I would go that far, but I'm a big believer in the company. I'm a shareholder myself. I've added to my position several times since I went public. And this is one that I will really be paying attention to just because, like I said, accelerating growth is really exciting. Strong growth is great. Don't get me wrong. All the growth companies we follow have impressive growth, but accelerating growth, especially when it's a 3-digit number, is really impressive.
Well, folks, you've got it there. SoFi is one we certainly talk about on the show from time to time. Look forward to catching up with you again, Matt, when the quarter drops. We can go over the results on the show and hit the good, the bad, and hopefully there is no ugly. Hopefully there is no ugly, but we'll just have to wait and see.
Sure.
But I agree with you. I mean, SoFi to me is just a fascinating business from a number of different angles, and I am fond of leadership there. I think Anthony Noto has just done a tremendous job. He's a tremendous advocate and ambassador for the brand, but I think he also, given his work history, it just really feels like this is the guy who knows exactly what he's doing. So I think there's a lot of faith there that leadership is making the right decisions as well. But we will catch up on that one when they report. And next week we'll give you a chance to shine the light on another company you are looking forward to this coming earnings season. But I think now for today, at least, that's going to do it for us, Matt. I, as always, appreciate you taking the time to join us.
Awesome. Thank you for having me as usual. And we're going to have to make a better title than guest for next time.
We're going to work on that one this week. I promise we can come up with a better name than guest. Yeah. Brother in arms, something like, I don't know. Just, yeah. Guest is just, it's got no, I'm not feeling the love there.
Well, I've been here every week for like 5 years. So.
Well, that's going to do it for us this week, folks. Remember, you can always reach out to us on Twitter at MF Industry Focus or drop us an email at industryfocus@fool.com. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Thanks, as always, to Tim Sparks for putting the show together for us. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next week.